Welcome, everybody, to the second quarter of 2025's Feldmeyer Forecast. You are joined today with myself, Alyssa Miller, as well as Ben is here today, too. We have a lot to cover today, so we're going to get through things pretty quickly. And here we go. We are going to be sure to cover tariffs, as that seems to be the biggest news story on just about anywhere you're watching. The impact that has on not only the stock market, but also the bond market. Keep in mind that this is changing pretty rapidly. We're recording this on Tuesday, April 15th. So anything that changes after that, we'll be sure to keep everybody updated on that as well. We're going to discuss some of the recession risk and discussion that has been going on there from our economic experts that we have been sitting in and speaking with. Inflation, unemployment, and the Doge initiative, a bull versus a bear market, and ways to take advantage of this slowdown in the economy for the moment, and any changes that we have made tactically to the investments as a result.
So all you have to do is open your phone, or let alone the newspaper or anything else, and this is what you're going to see. By the way, this is just one day's headlines that I grabbed out. Markets go haywire. Peter Navarro says Vietnam zero tariff is not enough, right? Stock market turmoil isn't over. It's a ton of messaging. So we're going to try to cut through some things to get down to what it is that we believe is the most important things for us to know today. Let's start with just what is a tariff. Okay, so a tariff, I'm just going to read this. Tariffs are taxes or duties imposed on imported goods by a government. What are they used for? The intent is to protect the domestic industries, encourage local production, makes sense, generate government revenue, reduce reliance on foreign goods, or respond to trade policies of other nations. And we've heard all of these as examples as to why it is that these tariffs are so important today. So what's their potential impact? Tariffs raise prices for consumers. That's what they do. They affect trade relationships with other countries, and they can influence our economic growth, because the more we have to pay for something, the less money we have to be able to spend on other things.
So let's take a look at historically where our tariff rate has been as a country. If you look back, pretty substantially into the 1800s, what we see is very, very high tariff rates, mostly because we didn't make anything here yet. Everything that we were going out and importing not only took a long time to get here, but was quite the process. That also included parts of the Industrial Revolution, where we started to bring manufacturing to the United States and be able to create more and more things here. So there was a push to purchase things from here as opposed to going back to Europe or somewhere else to get it. As the country evolved, we then had a change in that. And quite a bit of our global trade at this point is reliant on things that are being made in other countries. We have outsourced quite a bit of that. What we also see as a big comparison that has been going on quite a bit in the news is if you look right here at the 1930s, where there was that spike again in terms of our average tariff rate due to the Smoot-Hawley Tariff Act, was largely known and understood by economists as what expanded and deepened the Great Recession, specifically due to this right here. There has been a lot of talk in comparison of today's tariffs compared to then. Why has there been a comparison? Mostly because before the 90-day pause of some of the additional tariffs that were levied, our average tariff rate would have been back at almost exactly 25%. However, we are in a substantially different economic position today in 2025 than we were back in the 1930s.
So let's take a look at exports as a share of GDP for our country and our top trading partners. I'll call your attention to the orange line on the bottom. That's the United States. 11% of our GDP is exports. Everybody else, in terms of our top trading partners, have a bigger percentage of their GDP reliant on exporting. This puts us in an advantage if they're putting a tariff on us, but it puts them at a disadvantage to import their goods to us, okay, if we put a tariff on them. So this is one of the poker chips, if you will, that the Trump administration is playing, because they know that these countries are counting on the ability to sell to us. We're their biggest customer. That's a big part of it too.
So let's take a look at what that actually looks like in actuality. What you're looking at here is the largest export partners of each individual state. Now, this is where we are manufacturing or creating something here that we are then sending to somebody else. They're buying it from us. That's an export. So, not super surprising that we see a lot of the northern part of the country primarily sells to Canada, and the southern part of the country primarily trades with Mexico. And we can see some smatterings of other colors in there too, with China, Brazil, Germany, a few others. But surprising to a lot of clients that we have spoken to about this is how reliant we are on our trading partners to the north and to the south. And that also goes to show when we look at imports, who are we buying goods from? Well, primarily the same, primarily a lot of Mexico and Canada. Now we see a lot more in terms of orange on this map. We're buying a lot more from China. And of course, plenty of states are also buying from China. This is just looking at the number one trade partner of each state. So we know there is a substantial reliance on China in terms of their goods that they're manufacturing for us as well. But there is quite a variety. However, the top three do remain Canada, Mexico, and China. So those are the ones we're going to focus on when we look at how this actually impacts our consumers in the United States and clients today.
So if we take a look at the import value of our top trading partners, we see, first I want to draw your attention to the scale on the left-hand side. Notice the bottom line here is 400 billion. The scale is kind of zeroed in at the top of the scale, right? Above 400 billion. So it's not that Mexico is twice as big as China, right? We really need to look at the numbers here. But we import value of goods from Mexico, 476 billion. All the way over to the right, we've got Canada at 421 billion, and then slipping right in the middle, there's China at 427 billion. We can see these are substantial amounts of money, and these are key relationships with us in terms of dollar volume and the goods that we're getting from them.
Mm-hmm. And key to note, as of today, March 15th, April 15th, in terms of what is actually in place today versus what has been paused, because there has been some confusion on that when we've spoken to clients about it. As of today, the global 10% tariff rate on all countries is still in effect. And the previously discussed tariff rates with Mexico and Canada are still in effect, as are the vehicle tariffs are also still in effect. What was paused in the big 90-day pause that was big news was anything additional where we looked at country by country imposing some additional rates there. As well, China's tariffs are an ongoing discussion, an ongoing negotiation there. Those were not paused either.
So let's take a look at the value of the top 5 imported products by type of product and where we get them from. Now, these are big ticket items generally, right? So if we start at the bottom, we see cars, no surprise there. And then the color coding on it tells us who our trading partners are with this, right? Who are we getting these things from? Canada, Mexico, a little bit of China, and then of course the rest of the world sweeps in from Germany and everybody else. Scroll up on that with your eyes, we see oil. Oil is going to be a constant we're going to deal with. Then we have phones, computers, and parts for motor vehicles, which I'm going to venture to guess this isn't used part for used vehicles. This is more along the lines of importing parts for vehicles that we're going to manufacture here. So if we think about this and we think, how often do I buy a car? How often do I get a new phone? How often do I get a new computer? These are things that the price could change on it quite a bit, and you don't really notice it until you go to make a purchase. However, oil, of course, is something that we see daily because we put gas in our cars on a regular basis.
And these are ever changing as well. Part of the challenge for not only corporations, but also for the financial industry in general, has been keeping up with the rapid changes. Just over the weekend, end of last week and over the weekend, there was official announcement that tariffs from China on smartphones would be paused for now. So even just taking a look at some very specific components that are being put back in and pulled out is an ever-changing discussion. But when we take a look at historically, our three top biggest trading partners, what do we get aside from those big ticket items from these countries? What you see is Mexico, surprising to some, we get the vast majority of our fresh vegetables from Mexico, and about half of our fruits and nuts are also imported from Mexico, mostly due to the fact that climate-wise, they are able to continue to produce in seasons that we necessarily aren't from the Midwest and North. Canada, as a side note, is the second largest exporter to the US of produce, specifically vegetables. So what we're not getting from Mexico, we're getting a lot from Canada. We also get a fair amount of alcohol that's produced in Mexico. A lot of appliances are produced and shipped in through Mexico, and gas as well. When we take a look at Canada, again, the produce is going to be a big one that people will notice pretty much immediately in grocery store prices due to the short shelf life of a lot of these things. We'll see that first. But we also get a lot of machinery. A lot of oil comes in through Canada, lumber products, aluminum, iron, and steel. So a lot of our building products and a lot of plastic manufacturing comes out of Canada as well. China is a bit of a shift. We see two different ends of the spectrum from China. We either see things that have a lot more complexity to manufacture, like smartphones, lithium batteries, computers, things like that, technology. And then we get into just mass production when we look at toys, textiles, shoes, furniture, housing products, things like that. Ultimately, though, one of our economists that we get a fair amount of information from First Trust is Brian Westbury. If you're familiar with the name, we have talked about him quite a bit over the years. He came out with this quote yesterday morning when sending out his weekly update in terms of the discussions. Tariffs could temporarily depress economic growth as they leave consumers and businesses with less to spend on domestically produced goods and services. In theory, tariffs mean producers should shift some of their output towards being made in the US, which we talked about, on that first slide. But in the short term, businesses may balk at such a shift if they think the tariffs will be repealed soon anyhow. So this volatility with the tariff situation in general is what's causing a lot of the volatility within the marketplace, because it's causing a lot of confusion and disruption to companies in terms of what it is they should do in the long term, because there's so many changes here in this short term.
Something else worth pointing out just real quick that's way beyond the scope of today's discussion is that when you get further into things, for example, bottom left-hand corner, imports from Canada, 60% of the US crude oil imports come from Canada. We can't just say, well, we'll just drill more and that'll replace it, because there's a whole lot more to the story than that, because there's different qualities of oil. There's light sweet, which is generally what it is that we're getting from them. It's ready to go. But then we have oil that we're producing, right, out of the shale that's coming out full of phosphorus and other chemicals and stuff that has to be refined. Okay, so it's not as simple as we'll just make more of our own and instead of getting from them, because refineries aren't able to change the products that they're bringing in and what it is that they're doing with them overnight. So let's keep going. The outcome on this, of course, is that it's very difficult for us to know what a corporation's profits are going to be when we don't know what the inputs are going to be. So when we refer back to the price to earnings ratio, which is simply the cost per share to buy profits per share, right? So the cost to buy $1 worth of company's profit. How do we know what the company's profits are going to be? We don't, which makes the benchmark number that you would look at on things, which is price to earnings ratio, very difficult to understand. The other thing is that corporations report their earnings every 90 days. So in between them, there's a lot of guesswork relative to how are they doing? Are they going to announce a new product? What is the information that's going to come out? The bond market, on the other hand, is something that's getting a lot of attention, and here's why. Basics on a bond. Let's say I buy a bond for $100. It pays $5 worth of interest. That's a 5% rate of return, or a 5% yield. Okay, now let's say that something happens, like the Chinese decide to start dumping our treasuries into the marketplace, because Japan is the number one holder, China is second, and then it falls off from there. But let's just say that the Chinese decide to strike back on things and dump the trillion or so dollars worth of United States government treasuries that they own into the marketplace, and the price falls. Okay. It'll fall because there's a glut of products being put into the marketplace. Okay. And what happens then is our metrics change. And we've used a big exaggeration here to make the math simple. If let's say the price fell to $50, that means that the $5 of interest that I'm receiving would be a 10% rate of return on my money if I bought it at $50. Here's the issue. When we've got 34 trillion, $36 trillion worth of debt, and periodically we have to issue new debt to replace the old debt that's matured, right? We need it to roll over. But then we're also talking about a budget that could add another 4, 5, or $6 trillion onto our total debt. Any increments on things, small increments on things in terms of the interest rate that the federal government is paying, we are paying as a country on this debt is huge, huge, lots of commas and zeros. Okay. So what was it? We said a 1% change in interest rates on the treasuries leads to a $300 billion change in the amount of interest that we're paying over the course of a year. That's a 1% change. So this morning, the 10-year treasury, which is the benchmark that everybody's looking at, is at 4.365%. Let's just say that went to 4.465. That 0.1% would be a $30 billion change in the amount of interest that we're paying every year. Interest rates have to be kept low. It was one of Trump's promises that we're going to keep interest rates low. And the 90-day moratorium on the treasuries came out not because of the stock market, because of the bond market. There was volatility in the bond market. And if this thing seizes up because we've got too much selling going on, literally everybody's dumping United States government treasuries into the marketplace, we could have a real serious problem. So they're walking a very fine line of these trade agreements on things of saying, we're going to tariff this. Please keep buying our debt. Okay. This can be a very, very, very razor's edge, if you will, that we're walking here trying to get this done.
So due to all of this news in the market and due to what is ultimately going to be hitting people's wallets, we have seen a drastic drop in consumer confidence over the last several months.
That's bottom left there.
Would be your bottom left-hand corner here. The University of Michigan tracks this on a regular basis. And usually what we see here when we see this big of a dip is a soft indicator, but potentially a leading indicator to an economic slowdown. If consumers are concerned, we stop spending money. We start, battering down the hatches and
Cancel
say,
vacations.
we don't need the extra vacation. We don't need to do the remodel. We'll just paint. The old deck is fine. We'll have it last one more summer and see how things play out. See what the cost of lumber is going to be. See what the cost of all these things is going to end up being. The other thing that we see over the last couple of months is a progression in terms of a dip in CEO confidence here in the upper right-hand corner. The ramifications of this has been a couple of things, one of which we have seen delayed IPOs and paused merger discussions, which are things that we do need to continue to be able to see continued economic growth in the marketplace in general. We have also seen this translate into slowed hiring, potential layoffs, and slowed wage growth as well. Companies are not very keen to start raising salaries when they're not sure how much profit they're going to actually have this year.
And it also falls back on the cost of goods sold, right? If we don't know what our costs are going to be, as a CEO of a company, my confidence level is falling on doing anything at this stage of the game, which on the bottom right-hand corner, we see CapEx intentions. CapEx is capital expenditures, right, from major corporations. So you look at things and say, are they interested in spending a bunch of money? And the answer is not right now. All of these are indicative of the fact that confidence is low and spending is going to slow.
So if we take a look at adding some of these things together, inflation is something we have not touched on yet today. Good news came out of the inflation numbers in March, down to 2.4% from 2.8 in February. Fantastic news there. The concern is that this will be short-lived because this does not include any of the tariffs yet. Supply chains have a longer duration before some of this will start to actually affect what we're seeing in the marketplace. And companies are going to handle this different ways. Some of them will be able to absorb some of the cost if they have decent profit margins. Others, like groceries, have razor thin profit margins and will not be able to just fully absorb all of the tariffs, maybe some, but definitely not all. And we'll start to see those prices increasing at the grocery store, at Target, at Walmart, and at Home Depot, at wherever in the next couple months. The estimates at this point is that should probably peak this summer, probably July or August are the last expectations that we heard there.
This morning's news, by the way, is pharmaceuticals, tariffs to be applied on pharmaceuticals. This would be a huge hit on everybody, mostly the middle class, and the pharmaceutical companies themselves are saying some things there's just no margin in it. We have to make it someplace else. It can't be made here, or the price would be significantly higher. And pharmaceuticals are something that affects everybody's life. So that's hot news this morning that we're keeping an eye on.
Another thing to keep an eye on, the Federal Reserve. So when we take a look at interest rates in general, in tangent with inflation, one of the discussions has been that to keep inflation moderated, the Federal Reserve stepped in to raise interest rates when necessary, and then have recently looked at starting to lower those back down. The last rate cut was in December. It was very minimal, a 0.25%. And ever since then, they have said we are on a pause. They are going to take a wait and see approach. With some of the volatility, that is probably expected to continue. We're not going to cut rates if inflation starts creeping back up. The other mandate that they have is unemployment. Unemployment has also been relatively low and has continued to stay very consistent there at about 4.1%, a positive indicator for the economy as of now, which is another indication that we don't need to necessarily cut rates. So they're in a bit of a conundrum and have decided wait and see is the best approach as the dust settles, and then we'll go from there.
Well, the Federal Reserve has a problem that if this is a supply issue, that's different from a demand issue. So if it's a demand issue, we cut interest rates, the demand will increase because the consumer will have more money to be able to spend. But if it's a supply issue that there's just not enough goods, okay, that's back to COVID type stuff, right? Where there were no goods. So we cut interest rates. Now the consumer's got a bunch of money to spend. There's still not enough goods. You're going to be back to rapid inflation. So they're really committed to a wait and see.
Mm-hmm. Mm-hmm. We mentioned this earlier, wage growth. We are starting to see slow. One of the things that has maintained the economic prosperity over the last couple of years coming out of COVID was that wage growth was outpacing inflation as inflation had come down. What we're seeing is if that starts to slow and inflation starts to go the other way, even if it is temporary, that will be indicative of a slowdown in the economy because consumers can't keep up. Let's take a look and shift and look at Doge for a minute.
At the beginning of the year, and these are as good estimates as we can get. None of this is perfect because we're getting information from a number of different sources. But at the beginning of the year, we had around 3 million federal employees. And we've seen a reduction in that, the layoffs and closing of different departments and stuff, of around 10%, around 300,000 positions. The savings on the payroll there is about 30 billion. And when we compare that to how far we're overspending every year of 1.9 trillion, our federal deficit, it's about 1.5% of the federal deficit. Now, this is important. It does matter, okay? But it's not going to turn the deficit around, okay? Remember the $30 billion number I used earlier. 0.1% change in our cost to borrow money is a $30 billion increase on our budget. Okay, so we just wiped out all of that if interest rates move against us on things. The interest rates in the bond market are the number one thing that everybody is looking at this stage of the game.
So if we put a lot of these things together, we've talked about tariffs, some of the layoffs that we've seen, immigration we haven't touched on, but that's been pretty well documented in the news. When we put all these things together, each one of these factors alone is not enough to cause a recession. But if we combine all of these things together, there is a higher and higher chance of a recession, either that we're already in it or that it is imminent. We are getting these indications. You may have seen in the news, Goldman Sachs and JP Morgan have both come out this week and said that they have substantially higher likelihood of recession. JP Morgan's numbers were closer to a little over 60% chance. Goldman Sachs is right about the same. So it doesn't necessarily mean that it is a definitive, but it does mean that it is increasingly more possible. Keep in mind as well, should there be an announcement that we are in a recession or that we have had one, maybe later in the year, typically by the time that is announced, it is a lagging indication because they have to look retroactively at the math on things. And typically by the time it's announced, it causes a little bit, very short-term panic on things. And then once you look at the historical charts, what we see is really the pain and the majority of the downturn has already passed. And once that discussion is announced, we're already starting to see some improvements. So just something to bear in mind over the rest of the year, because this will be a common discussion that will continue to arise and something to just be cognizant of. So what happens if there is a slowdown in economic growth? A weaker economy becomes more likely that we could see a handful of different things happen. And here's a little bit of the concern here. Congress is one place that we have traditionally seen stimulus come from. The other place is Federal Reserve cuts. We just talked about that and the likelihood of that, probably very unlikely, at least for the foreseeable future. So what could Congress do? Well, they could step in and provide some stimulus to help motivate the economy and move it back in the other direction. However, their very clear initiative has been to cut spending, not add spending. So therefore, it would seem unlikely as of today that they would push for any sort of additional stimulus to be flooded into the marketplace. So what is the other possibility? Another possibility is that we could see the Tax Cuts and Jobs Act expanded or extended. It is looking extremely likely that that is going to be at least extended. The discussion now is that there could be expansion and deepening some of those cuts. They've also thrown around the idea of eliminating Social Security tax overtime and tip taxation to help motivate the economy and to help the middle class. We'll see if any of that ends up actually happening. But the likelihood of an argument there is becoming more likely as well, especially if we see a slowdown in the economy. They want that economy motivated for lots of reasons, also to have a strong showing coming into the midterms next year.
So is it different this time in terms of a business cycle, right? So if we read from the left to the right, our left side axis is stock market returns, and our bottom line, excuse me, across the bottom is time, right? So as the market goes up, we follow the curve here. Everybody's happy about things. We even reach a euphoria of saying, I should have invested more. I'm not conservative. Let's become more aggressive on things. And that is a time to rebalance and be cautious when everybody else is buying. And we have done that. And as things start to slow down, which is where we think we are, we hit this line here that says, it's okay, I'm a long-term investor. I've heard these words probably 15 times in the last 3 days, okay? But it's okay, we'll be all right. If things continue to slow, if the tariffs set in some problems, if the market falls, and we find ourselves on the lower side of this, the question will come out to, it's different this time. But as things bottom out, that's when it's the worst. That's when folks reach the point of saying, I'm out. Just forget it. I'm just going to take my losses. I can't take this anymore. And I'm not getting fooled again, as it says here. But in fact, that's the time to be buying, right? It's the time to rebalance and consider the fact that when everybody else is getting out, that's probably the best time to be getting in. What we need is clarification on the tax code, the budget, and also the tariffs, because we have to get an idea of what is the outlook on profits. Until we get that, it's going to be very difficult to know where we are.
Quick overview, and on a bull versus a bear market, these terms get thrown around quite a bit in times like this.
Because we could be headed into a bear market at this stage of the game.
Yeah,
That's the concern.
That is the discussion. And a bear market, very generally speaking, is a downturn in the market that's prolonged. But as you look at the duration in those red numbers at the bottom, what we're seeing is there are some longer ones, 25 months, 21 months, 19, 16, but there's also a lot that are 2, 3, 6 months. So substantially lesser periods of time, which we can see visually here compared to 155 months, 153 months, 131, 61, substantially longer periods of time. So keep that in mind as well, that if there is a slowdown on things, they are usually more short-lived, especially when we compare it to some of the most recent downturns that we have seen in modern history, especially looking at 08. When we compare where we are today and what it would take to turn things around versus what it took to turn things around in 2008 are drastically different situations. Saying we had a true financial crisis in 2008 due to a magnitude of factors that combusted all at the same time, compared to today, this is more of a man-made scenario that we could quite literally, with a single tweet or press conference, change things around very quickly. And we may see that. We may see some of these countries coming to the table, negotiations happening over the next 90 days, and things settle down quite a bit, or not. So we will just have to wait and see and continue evaluating as things progress over the next quarter or two.
So what are the steps to do if we are in a down market? As the note here says, the temptation to abandon a good plan increases with the volatility of the moment. Boy, isn't that the case. When we sit and talk about things, everybody says, yep, it makes perfect sense. But when the rubber starts to hit the road and your account is worth less, we know that psychologically, that's 10 times harder on us than seeing a statement that's up, right? The downside hurts us 10 times more than the pleasant feeling we feel of saying, oh, look, my account's worth more than it was before. Okay, so what are some things that we can do? Well, the first, of course, is if you're saving, continue to save. As a matter of fact, some conversations I've had with folks is they've said, I'm only saving 6 or 7%, excuse me, into my retirement plan. Should I be saving more? The answer is does your cash flow support it? If so, yes. And by doing that, you're dollar cost averaging. So if things are going down, you are in fact buying at cheaper prices. Just keep buying. Roth conversions, take it out of this account, put it into that account, pay tax on the amount that moves over, but then you never have to pay income tax on that money again. Would I want to do that at the market's all-time high, or would I want to do it when things are low? Well, if the expectation is that things are going to recover at some point in time, moving over to Roth when things are low, you can literally move more value faster. So Roth conversions is something to consider. Evaluate your allocations on unmanaged accounts. Lots of clients that we talk to say, well, that old 401k, we'll just leave that where it is. I don't really pay attention to that. I barely even open the statements. It seems to have done okay over the last decade or so that I haven't looked at it. That's fine. But in a time like this is the time to be using strategy on your money. We're going to talk about the strategy changes that we made here in just a minute. So leaving unmanaged accounts alone is a bad idea. The other thing is remember, there's 6 key areas to a comprehensive financial plan, 5 of which we have complete control over. Only one is the one that we don't have any control over, and that's the actual rate of return on our money over time. We can change our risk, we can change our strategy, we can change all kinds of things, but day to day, we don't have any control over it. So focus on the 5 where we know we have control.
So taking a look at some of the tactical changes that we have made, the core models is a reference to, if you've had us discuss, you're in the moderate conservative model or the moderate model. That's what these are. What we have done in this top box, this is where the allocations were. And remember, these are the exact same investments. It's just what exposure to them do you have? So the conservative model originally had 15% stock exposure. We have dropped that down to 0 in the conservative model, gotten out of equities entirely. Alternatives is usually something that is non-correlated with stocks and bonds. A lot of that is real estate, which again, due to the tariff concern, is something that we have a little bit of a little bit more apprehension about. There's also several other things in there as well, commodities, metals, things like that. So we have reduced some exposure there, and we have moved some of that exposure to cash. Now, reminder, cash is not just literally cash sitting there doing nothing. That is money that's in money market funds that is still gaining interest there. But we have moved almost every single model to a much stronger cash holding to say, let's sit and wait. We have trimmed the equities, added to cash for a couple of reasons. One of which, to get out of the volatility. Secondly, to say we are now tactically advantaged to be able to get back in where we want to be when we want to be there. Additionally, we have removed some of the categories of equities out entirely for the people that are still invested in some equities. The companies that are the most sensitive and the parts of our economy that are most sensitive to the tariffs are going to be our smallest companies. Small businesses get hurt the hardest when things like this happen. So we have removed exposure to those and stuck with our tried and true larger companies moving forward. If you look at the stock model, which a lot of you are probably most familiar with in the Roth IRAs or some of the non-qualified accounts, the stock models are the individual stock positions. There's no funds in there. We added gold a lot earlier in the year as a hedge against volatility that we knew was coming just due to any change in administration. That's common. That has held up very, very well and helps to moderate some of the volatility in the model. Going forward, we have increased the cash pretty significantly for the same reason, to be able to be tactically advantaged, to be able to jump back in. Removed securities that have the highest tariff sensitivity, mostly textile companies and grocery. We've also gotten rid of any travel and leisure industries due to any sort of recession risk, and reduced semiconductor exposure. We still have NVIDIA, but have gotten rid of Broadcom to diversify some of that risk as well in the tech sector. So we have several things that we are monitoring very closely, a couple things that we like, but are not quite comfortable jumping into it just this minute, waiting to see how some of this volatility in terms of the tariff discussion pans out, and then we'll be ready to jump back in when it's appropriate. The bond and high yield models are not specifically addressed here. Any of the smaller changes that we made to those models will come out in the newsletter, so be sure that you click that link at the bottom of the newsletter if you're interested in that. For the most part, those are relatively unchanged because the yields are remaining pretty consistent, and we're just continuing to generate income there.
So as we wrap up, I want to thank everybody for your attention today. We are trying to consolidate information and get it to you so you can get through it all at one time, as opposed to every single day sending out what's the latest, what's the latest, what's the latest. So we're going to be in touch to communicate with you. We're handling things on this end. And as of today, the Feldmeyer Financial Group is saying, let's be patient and see how all of this works out. So you can see from our changes in our allocations, we're increasing our cash holding to be sure that when we have a green signal here, right, that we're happy with what it is that we're seeing here in the markets and the outlook on business and the tax code and the tariffs and everything else and stuff, we'll be ready. But in the meantime, conservative is the best thing that we think we can do on all the allocation models. So thank you very much for tuning in, and we'll talk to you again soon.